In February, Kane Island put out a three-factor model for valuing Ethereum. I got a Ethereum chart here from the slide or the deck that you sent me. Can you walk us through how you value Ethereum versus Bitcoin? How do you view it generally?
Yeah, one of the things you have to look at with alts is that, first of all, you have to start from the premise that most people don't know about Metcalfe's law, or they don't care. And so they take their cues on what the price should be from other assets. And that's common even in the traditional world, right? We want to look at a stock, we look at a comparable stock and see how the performance goes. So absent some other information, when people buy and sell alts, and Ethereum in particular, they will take their cues from Bitcoin, because Bitcoin is the dominant asset out there. And even if it's not rational, people will still do it. So most of Ethereum's performance is intrinsic. It comes from things like user growth and transaction volume. And that's about, what I got there, 70% of Ethereum's price is from Metcalfe effects, network effects, the growth in users, the use of the token. But some of it isn't. Some of it comes from just Bitcoin moving up and down. Now, those two things shouldn't have an impact on each other. I'm not a believer that Ethereum competes with Bitcoin in any way. I look at Ethereum completely differently. It's a database. It's a programmable database where you can store data on it and transact and monetize that data. That's a completely different use case from Bitcoin. It's not going to overtake Bitcoin in terms of its use case. Maybe it would in terms of its cap, but I think that's also doubtful. So, Ethereum really does look a lot more like a tech stock, to be honest, but it gets its value from Bitcoin in part, and then there's some other factors out there as well that are random noise and who knows what. But most of it comes from its internal uses in terms of user growth and transactions.
Does seasonality play a part in terms of digital assets? I mean, we only have that 13-year window with Bitcoin, but in your analysis, have you noticed, some people say, oh, it's alt season, or, oh, it's Bitcoin season. You can kind of measure Bitcoin's dominance. Do you look at that at all?
I did. I wrote a paper called Proof of Alt Season. I was surprised. I hadn't learned much about seasonality until a guy named Barry Bannister at Stifel Nicholas came and gave a presentation in Houston that I attended, and he explained seasonality very well. And I did a lot more research into it. So let's forget about altcoins, but just in the equity markets and real estate and every other market, to be honest, seasonality is a real thing. You do get these end of year from about December, or I guess it could go from October to April or December to May, depending on how you want to look at it. These boosts in asset returns that coincide with an annual calendar. And the interesting thing is it happens in all assets and everywhere around the world in all markets. It's a real thing. I was really surprised to learn that. So when I started looking at altcoins, it all made a lot more sense. And I did do some statistical analysis and find that seasonality does exist in altcoins. It runs from approximately December through April or May. However, there's a caveat to that. And people are finding out this year. In years that feature a recession, seasonality doesn't come into play. And it has to do with, to explain why seasonality exists, think about being an institutional portfolio manager and it's September or October, and the next year's estimates are starting to come in as to what performance of a particular stock was going to be. And some of them you might think are going to be bad, or you're at least skeptical. And so you panic. And that's why we have so many crashes in October and September, is because you're fearful about the coming year. It's too uncertain. So you get this sell-off in fourth quarter. And then the year rolls around, okay, and you start getting the estimates, revised estimates in for earnings in January and in April. And there's a surprise effect there. They're positive. And that boosts you get this relief rally, except in recession years where the estimates come in and they're like, oh, things are going to be bad. And you don't get that relief rally. We didn't get that alt season this year because the estimates that were coming in January through April were all to the downside. In fact, Nomura just revised U.S. GDP down to negative for the first time in a decade. So yeah, it's a real thing. It's a real thing as long as you're not in a bear market and recession. But in positive times, you can actually generate some alpha by trading that December to May window.
That's interesting. Yeah, that actually makes a lot of sense. I mean, even you think of just 2018, 2018, when did things start to roll over? It was October until, I think just, the end of December. And then that's when the market kind of did its thing and bounced back. And then this year, again, kind of the same structure. We had Bitcoin and crypto breakdown October, November, and then equities kind of follow.
Yeah, there's also another theory that I don't know if you've heard about seasonal something disorder, where in the winter, people get depressed, and as winter rolls along and you get September, October, you get people that are less optimistic in their outlook on life. It's just a human thing, and it could possibly do with the amount of sunlight you're getting. Most markets are in the northern hemisphere. And so sunlight gets reduced. People start feeling so bad. The bad news starts to pile up, and it shows up in the markets. And there is a reason why most crashes in the S&P 500 have occurred in September and October. There's a huge disproportion of down months in the year in September and October, and it doesn't happen every year, but it certainly does happen.